How's everyone doing so far today? Good experience in doing this?
Yes.
Fantastic. Well, congratulations everybody. We appreciate everyone being here, whether you're a finalist, whether you're a sponsor. The point of this expo is to make sure that we're imparting value as much as we possibly can, develop those connections. And so this particular breakout session, we're happy to share what we call the Leadership Roundtable, and this is where we're going to look at ways to scale. So when you think about that, building a company to scale and then also building it to last. And so we've got some great panelists up here, just a wealth of knowledge. We're going to go through, I'll make some quick introductions, and we're going to jump into it. We'll go through some questions, we'll do some insight, there's going to be some open Q&A on that as well too. But this is designed to be interactive, and so when we kind of get through some of those panels, we're just going to throw it out there. We'd love to be able to talk and chat and just kind of bring out to the forefront whatever we possibly can. All right, so first of all, I'd like to introduce Justin Vaughn. He's going to be moderating the panel for us today. Justin, if you want to just introduce yourself and tell a little bit about your background.
I don't, but I will anyway. Hi, my name is Justin Vaughn. I am on the board of Colorado Companies to Watch, now on my second stint, because I was on the board previously for about 8 years. I do a fair amount of philanthropy, involved in some community activities, and in my spare time I have a law firm and a business brokerage that I run. So glad to be here today, and thank you all for attending.
Thank you, Justin. Max Golovin.
Good afternoon, everyone. My name is Max Golovin. I'm with the JP Morgan Private Bank here in Denver as a wealth manager. I've been with the firm almost 8 years, 12 years in the industry. And in my role, I work, advise, and support business owners, particularly with a focus on pre-transaction planning.
Excellent. Mr. Doug Dell.
Okay, I guess we're standing.
Yeah.
Yeah, I'm Doug Dell. I'm with JP Morgan Chase's ESOP Advisory Group, so I have a very specialty practice helping companies sell themselves to their employees. So it's something that I've been a CFO for an ESOP company early in my career, and that's where I got a passion for employee ownership and how it helps to build that wealth gap that we see in our country. And so we're hoping that with the silver tsunami that everybody's heard about, that we'll see more and more people looking to this option as they transition out.
Fantastic. Thank you. Last but not least, Brian McQuinn.
Hi, so I'm an attorney. I'm with Foster, Graham, Milstein, and Kalisher. I'm in the corporate and transactional group, so we do kind of full service everything as outside general counsel for businesses. But the bread and butter and primary focus of what we do is usually equity events or liquidity events. So whether that's initial investment and capital raises or debt or in particular exits, we do something like 20 or 30 M&A deals a year. So that's most of our bread and butter, and I guess I actually started out my career in-house working with End Credit Union, now Wings, where Richard is based. So.
Awesome. We actually had that conversation, but yeah, and then I'll be jumping as well too. I think you heard the introduction earlier, Richard Hearn with End Credit Union becoming Wings. No, it's not sponsored by Red Bull. That's just the aviation background we're going into. So with that in mind, we're going to jump into the panel. We're going to do as much as we can to impart some knowledge and go from there. So. Justin, I'll let you take it away.
Thank you, Richard. Panelists, do you want to sit? Do you want to sit?
I prefer sitting myself.
Can everybody see us okay? Can everybody hear us okay?
Yes.
We'll try to project. I think everybody here has heard the common phrase of the definition of insanity, right? Everybody knows, what is that?
Doing the same thing over and over again, expecting different results.
And doing the same thing and expecting a different result. What I've found is that when you look at other cultures, you also find a consistent definition of wisdom, right? And so if we want to escape insanity and embrace wisdom, what we look for is truth, logic, experience, and grace or compassion, depending on which worldview you're talking about at the time. So the idea is, as business owners, as advisors, as leaders, is let's make sure we're looking for truth, for information, for more wisdom, for the opportunity to turn to advisors who have experience, who have the ability to enlighten and can bring that to the forefront. We're not necessarily going to cover every aspect of business. We're not even going to try. But we do have some particular aspects that, as you're exploring options, as you're trying to implement strategies, some of these or all of these hopefully will be helpful to you to understand, to consider. Now, I want to know who we're talking to as well. Who are my advisors, consultants? They're all in the high school back row over there. They're massively populating it. Okay. And who are my business owners? Quite a few. Well, thank you for being here. I would love to hear about each of your industries, but that would consume the rest of our time, so I'll move on. You've heard the introductions already. Let's talk about a little bit about, we'll actually start with funding, if that's okay, Richard.
Sure.
We'll talk about access to capital, which is always at the forefront of business needs. Richard, can you, a company can hit a ceiling for a number of reasons. It could be culture, it could be leadership, it could be operations, but capital is, often seen as the solution for hitting that ceiling, for reaching your next stage. How can you describe the support for second stage entrepreneurs like we have here, especially those evaluating their business needs and navigating the need for capital?
I think that's a great question, because it's what makes the business world go round, right, is access to capital. Because if you don't have the money to be able to operate, you don't have the ability to go out and market and be able to do the things you do, pay your employees. So within that, again, I kind of joked about this earlier, but a lot of people look at me as a banker like, well, the only way I can access capital is through debt. Well, it's probably the most common ways, but there's always access to capital. The question is how much you want to pay for it and what type is it? Because when you think about that from a business, whether you're a startup, whether you're going to be stage 2, whether you're now in that scalability side of things, there's always access to capital, right? The first one is you put it in yourself. You can take money from your own personal accounts, you can put it into the business, you can invest it that way, right? There's grants and there's some donations and some other things as well too, and then there comes into the debt portion, right? And so that's typically going to be a lender-based credit facility. And again, there's different types out there, different types of capital, whether it's a working line of credit, whether it's going to be real estate, whether it's going to be acquisition. There's different ways to do that, and I'll touch a little bit on some of that, the parameters there. And then the other part too is, and then we come into it is the mergers, the acquisitions, is the private equity, right? And so within these, every single one of those has a cost. Your own money doesn't cost you anything, other than the fact that maybe a little less sleep at night. On the bank side of things, when you look at that, it's going to be something that there's an evaluation happens, and they're going to go through historical financials. And so in preparation for that, the first thing I would say is, again, going back to teamwork, make sure you've got a good CPA, make sure you have a good accounting team, or however you want to account for that too. But most lending institutions want to go back, look 2 to 3 years on your historical cash flow. They're going to look at what the bottom line profitability is. They're going to look at what the tangible net worth of your company is. If you're taking distributions out, you're sucking everything out of that company, not leaving into it. That makes that less attractive, right? But within that, they're going to go through a pretty fine-tooth comb, and you're typically going to get the best pricing on that, and typically in terms of interest rate, right? Because it's something that we've examined. On the other side of that, and a little bit further down the scale, at the highest cost is when you actually give up equity in your company, and that's typically through that merger, acquisition, private equity side of things. Because at this point, now you're giving up equity in the company, you're giving up revenue streams. But again, access to capital is always there. It just depends on what it's going to be and how you want to access that. And again, not to be redundant, but it's those proper conversations. It's about planning and making sure that you've got all your ducks in a row before you go out and have those conversations.
So let's talk about some of the other ducks. You touched upon financials and making sure your financials are in order. Are there other things an owner can do, particularly looking at lending, looking at the debt side? Mm-hmm. Are there other things they can do to maximize the likelihood of having that access or other tools from a banking institution?
Sure. And again, too, I think, part of that is oftentimes when you go into a lending institution, say I want a loan, they say, okay, we'll pull financials, we'll give it to an underwriter, and we'll let you know. Let's know what, right? at the end of the day, I think it's actually helpful as a business owner to understand what the credit process is. Again, I kind of mentioned on that too, is that when you look at this, a lot of times, again, from managing cash flow and having people who are actually looking at the books and understanding the ratios. Top line revenue is great, but if you're running on a negative and you're not showing positive and you can't service the debt flow or the debt service on a credit facility, you're not gonna be able to qualify for that loan, right? Collateral component is, we've had a lot of these conversations, actually had some of this out in the lobby earlier. You could probably justify the need for a very large credit facility, but unless you have the collateral to back that up, and that could be tangible net worth, that could be real estate, that could be accounts receivables, that's going to be challenging. So understand, particularly if you're in that stage 2, SBA and some of the other options that you can look at to be able to mitigate some of those things. Again, having the conversations, I think, is at the end of the day, is just understanding that what is a lending institution going to look at, have the people in place to be able to provide the financials, and it doesn't have to be an underwriting event. You can look at those financials. A lot of us come out and take a look and say, you might be a little deficient in here, and here's some ways that we can actually kind of mitigate some of these before we get to an actual underwriting event. Never a guarantee, but at least we can give you the best chance at it.
Actually, I think that's an important point, that, the best time to seek capital is when you don't really need it. So having a relationship with a banker before you need it, making sure that banker understands where your business is heading. One thing as bankers we don't want to do is lever up your company, but then you're constrained on capital and growth going forward because you're paying off debt. So, if you're able to communicate your business plan with your banker and let us know where you're headed, we can structure and tailor customized financial packages for you that allow you to meet your goals.
I appreciate that. Are there any further insights you might offer when somebody's trying to choose between debt capital and equity? Is there a way that they can look at it and say, okay, for my company, in my situation, I should be looking at venture capital, or in my situation, I should be talking to a bank and pursuing a bank loan?
Sure, and that's one of those things, this is open conversation, I don't want to dominate.
No, you're fine.
Well, you're only going to dominate for another 30 seconds.
Okay, good. No, again, and I'll touch on this, and I mentioned earlier too, a lot of it is personalized, right? What is your goal with this, okay? So again, I mentioned this, if your perspective with the business and what you want to be able to do is grow it, but your goal ultimately is to move that to a family event or to an employee event, well, that's going to be a different strategy than when you want to maximize it for the most amount of profit when you can take out of it when you finally exit that business. The one last thing I would say is that, also understanding the types of credit, right? Again, you don't want to mismatch your credit pieces. As he mentioned, is that, sometimes people will take out a line of credit, which is just a revolving facility that you can draw against too. A lot of times that's taken out for long-term processes, but that really is a short-term instrument. That is something that should be paid off in 30 to 45 days, put to rest. If you max that out and let it out for 5 years, it's going to cost you a lot of money to do that, and it's not going to look great on the financials if someone does come in to look at buying that.
I would just add on to that,
Yep.
from my perspective, that one of the big differences in the equity piece and giving up equity is that you're giving up control inherently. And maybe there's value to that because your equity investors are providing tangible or useful skills that the business needs and or back office functionality or things like that, which is what we see a lot with some of the roll-ups that go on, that they're offloading high-cost areas of the business, and that's part of the value of giving up some of that control. But beyond just the financial piece, the equity is going to cost you some level of seat at the table.
Yeah. And if you're seeking equity, it's because an equity provider is going to want return. They're going to want your company to be sold in a certain amount of time because they want their return on their capital. So if you're seeking equity, it's because you're planning that sale, which is great. But different than if you're seeking debt, where you, like you say, retain that control and maybe you have a more sustainable target.
Well, and Doug, let's do a deeper dive into your area. Let's talk about ESOPs. So I've had people who come forward and say, well, I can't find a buyer. Should I do an ESOP? Or I want to provide for my people. I want to motivate. I want to give back to my employees. So I want to talk about an ESOP. What do you hear? What do people come to you saying when they're exploring the possibility of that pursuit? Yeah,
an ESOP can accomplish a lot of different goals. It kind of depends on what the seller, the founder has in mind. an ESOP you can sell anywhere from 1 to 100% of your shares to this ESOP trust, which eventually will benefit your employees with the retirement plan. The employees will have stock allocated within this trust over time, and when they retire, the company will buy those shares back. But you know, the ESOP can be used if you're looking to diversify some of your wealth. I mean, you've got your wealth tied up in your business, you've built it up. Maybe you want to do some other things. So maybe you sell a minority position in your company to the ESOP trust. You have now liquidity to go do other things. We see that quite often. You know, if you're someone who's formed this company years ago, you're ready to retire, it's certainly a retirement and liquidity event for you. You can sell 100% of your shares to the ESOP trust. And the nice thing is you don't have to relinquish control. You can still stay on in whatever position you have. You can still stay on the board of directors. You can still maintain the legacy of the company. And kind of to your question, what we hear more than anything else when somebody's considering a sale to an ESOP, it's because they want to retain the culture of that company. They may not want to see it sold to a private equity firm, which will in turn sell that company again in 5 to 7 years, and who knows what's going to happen to our employees, who knows if this company is going to stay in the community. That's important to a lot of owners, just that legacy factor. And you mentioned too, it's rewarding your employees who help make you successful. So you can have your liquidity event. The ESOP will pay fair market value for your company. It's financed through a combination of debt, so you'll get cash up front through bank debt. But usually you're also taking a portion of your payment over time as seller debt. So that's the usual way that an ESOP is accomplished, is some combination of bank debt and seller debt. So if you're selling your company to an ESOP, you have to be willing to take your payments over time, versus if you were to sell to a strategic company or to a private equity firm, you'll get your cash up front and you can leave and go do what you want. But that company is going to be subject to the control of that private equity firm and out of your control.
Thank you. For those who may not be familiar, can you explain to us what an ESOP is,
Yeah.
how that process works, and who the advisors are involved in that process?
Sure. So ESOP stands for Employee Stock Ownership Program. And it's just a method, it's a method for you to sell your shares to your employees. The way it works is you decide you're ready for a transition or a liquidity event. You'll hire a financial advisor who will tell you, this is what we think you can sell your company to. This is the kind of the price we think if you sell to an ESOP. And if that's attractive to you, you'll then form this trust, losing my voice already, form this trust, and you'll hire a trustee. And that trustee is responsible for negotiating the sale price on behalf of your employees. So the seller, usually using a financial advisor like an investment banker, will negotiate that purchase price. And then a bank, like JP Morgan, I do specifically financing for ESOP transactions. So the company might come to me and we'll determine what the debt capacity of that company is. We'll make that loan to the company. The company will take the funds that I've loaned to it, loan it to the ESOP trust. That's how the ESOP trust then has funds to buy your shares. The trust will buy your shares. And then the stock is now held in the trust, and it's held for the benefit of the employees. So your employees don't get the stock immediately. Your employees don't run the company. They don't make decisions. They're called indirect owners, so they own the shares within a trust. Almost like owning a public company, where you don't really have a say in the control of the company, but you have a share in its growth. So through various mechanisms, that stock is allocated to the company's accounts over a long period of time, or to the employees' accounts over a long period of time. And that's because we want this to be a retirement program for the employees. We don't want the stock to be allocated all at once, because you might incentivize those employees to just go out and take their payment and go somewhere else. We want this to be long-term. And every year, the trustee will have a valuation done. So every year, the employees will see how much stock has been allocated to their account that year, and they'll see what the value of that stock is. And the beauty is, when those employees start to realize that, hey, my actions in this company my actions to make this company more profitable or to generate more sales will increase the value of my shares. So you have employees who start to think like owners. And what we find is companies that are owned by their employees, they tend to be more profitable. They tend to have a more stable workforce. They're less likely to lay off. There's been lots of studies about this, and then we even find now some private equity firms like KKR that you may have heard of. They're actually understanding the benefits of employee ownership. So we're now doing deals in partnership with private equity and selling to the employees. So we're expanding that universe.
I have a question. Is the owner classified as an employee for this?
You can be, yeah. You can sell your shares and still be an employee. There's a little detail to your question. So one of the nice things about an ESOP is if you make this election as an owner, you can elect to defer your capital gains on the sale. So that's attractive to a lot of sellers who have a very low basis. So to your question, if that owner makes that election to defer the capital gains, he can't participate in the ESOP. If that owner chooses not to make that election, he can certainly be part of the ESOP again. But while you've asked about taxes, and I don't want to.
No, that was my next question.
Yeah.
I was going to ask you about tax advantages.
Yeah, so one of the nice things about an ESOP is the government likes this program, both sides of the aisle. If you're on the conservative side, it's about capitalism, it's about hard work, it's about seeing the results of your work and the growth of the company. If you're on the more progressive side, it's about bridging that wealth gap. And what a great way for employees who may otherwise just live paycheck to paycheck to start building wealth in their ownership. I've seen millionaires created. I feel proud because we've put ESOPs in place where we've seen administrative assistants who've been with the company for 30 years. They're walking away with six-figure retirements. It's just a way for people to be able to retire with some comfort. So what I was saying is the government likes this, so consequently it's a tax advantage program. One of the ways that the company saves taxes if you're an S corporation, and you might know as an S corporation, you don't pay taxes as a company, your shareholders, your taxes are passed through to the shareholders. So the way a normal S corporation operates, the company will make distributions or dividends to those shareholders to pay their taxes. If you're owned by an ESOP trust, the ESOP trust doesn't pay taxes, it's not a taxpayer. So the company no longer has to make a distribution to its ownership to cover taxes. You're a tax-free company. So you've borrowed to do this transaction, now you're not paying taxes. That allows you to pay the bank back quicker. It also allows that seller who's taken back some paper to be paid over time to get that paid back quicker. So it's a very powerful incentive to be a tax-free company. What we find in practice is when companies get their debt paid off, usually 5 to 7 years, now they're amassing cash because they're not paying taxes, and we find that they're going out and making M&A transactions, they're doing acquisitions, and that will continue to raise their share price.
That's a great segue. Thank you for that. Let's turn to Max and talk about some planning for a moment, because I emphasize this to all of the business owners I work with. If you haven't set your destination, if you haven't identified where you want to be at the end of this journey, then your journey meanders. Your current decision making isn't aligned with whatever objective you want to get to. Max, let's talk about the importance of planning and when that should start in your context and in your world.
Yeah, I think that's really been the theme of the day in many respects so far. Start planning when you can, not necessarily when you need to. And part of that, particularly my role as a wealth manager, is having those discovery conversations with business owners, right? Helping them articulate and define their goals, what that means to potentially pursue a business sale in the future, what that ultimately is intended to accomplish for them, right? And I think starting that conversation early, particularly if your end goal is ultimately a transaction, allows you to align all of the stakeholders on the transaction team on the same side of the table with you, right? So think of your tax advisor, M&A advisor, corporate attorney, trust estate planning attorney, wealth manager, all working cohesively towards a deal path that ultimately is aimed to accomplish your objectives. And I think without that, you know, whether you're getting unsolicited offers or, you know, or not, you know, being able to respond to those appropriately with an end goal in mind is really what sets you up for success.
Appreciate that. And let's get a little more granular into some of those tools. I know particularly in transactions, I work with people who set up donor advised funds. I'm sure you're familiar with that as well, to create certain tax benefits. What are the tools you're seeing? What should this group know in terms of things that you can implement and utilize, whether you're looking at a transaction 5 years down the road or tomorrow? Sometimes people come to me and say, I wish I had sold this 2 weeks ago. But what do you see?
The problem with that, though, is as far as the IRS and how they view a lot of these planning techniques and strategies, they'll completely invalidate them because they understand there is a transaction in motion and you're essentially just trying to shift capital gains taxation off of you. So they'll often invalidate that and you do, in fact, owe capital gains tax. But to your example, I mean, donor advised funds are a big one. And I think what is super important for these high impact, particularly tax and estate planning strategies, is to start early, right? It takes a while to evaluate and analyze if that's even the right fit for your particular unique situation. And then on top of that, you know, implementing that idea takes time as well. So if you have a signed LOI or momentum towards a deal, it's likely too late to implement that stuff. So if you take the time up front, you know, that can create a lot more tax efficiencies in particular on the back end. I think a couple specific examples for you that you just mentioned with, you know, gifting private company shares with donor advised fund, you know, that has a lot of impactful benefits. You know, first and foremost being you're supporting a charity you're choosing, which can have long-term benefits, you know, to the extent that legacy planning is important to you, that's a great way to kickstart that process. And then certainly, you know, as you're gifting shares, you know, typically non-voting, right? So you retain control of the direction of the business. That gets the value of the gift and the future appreciation off of your balance sheet. So in the future, if there are estate tax considerations, that'll reduce that liability in many cases. I think what's interesting about gifting to charity is the income tax benefits, right? So in the year that you make that gift to charity with the private company shares, you can get a income deduction up to 30% of your adjusted gross income in that year. And certainly if that's aligned with the sale of a business and a transaction where you'll have a particularly high income year, you know, that can have some pretty substantial benefits.
Yeah, and to dovetail on that, you definitely want to plan as much in advance as possible. What about QSBS? What about Qualified Small Business Stock?
How many people here are familiar with QSBS? It's been a bit of a hot button topic among just a few business owners. You know, actually last summer with Trump's One Big Beautiful Bill, they actually extended the eligibility and benefits for QSBS, so it's been in the news a little bit more readily. But essentially QSBS, or Qualified Small Business Stock, is important to business owners because it can provide pretty substantial federal tax benefits. At a very high level, what that looks like and quantifying it is the first $10 million of a capital gain or 10 times your original investment basis, whichever is higher, would be free from federal taxation on a capital gain basis. So not every business owner can claim this, right? Not all stock in a private company is eligible for QSBS treatment, so it's super important to understand the criteria, which there are 3 primary criteria. First, the company has to be a U.S. domiciled C Corp. The type of trade and business they operate is typically focused on product development, software development, or technology development. Unfortunately, professional services type of businesses are not relevant nor deemed eligible for this type of tax treatment. Second is the actual stock itself. It is typically original issuance stock. You know, it can be received over the life cycle potentially of employment with that business, but it can't be acquired in a secondary market. And also the acquisition of that stock, whether it's original issuance or later, needs to be when the company has gross assets less than $50 million. And then finally, the holding period have to hold the stock for at least 5 years. If you hold it for 4 years and 364 days, sorry, you're paying full federal taxation on the capital gains of the sale. So that part is super, super important. And I think this gets back to the theme of planning ahead. Like if you think that potentially a sale is in the horizon 4, 5, 10 years down the road, you know, get your team of advisors together, understand if some of the corporate restructuring or other items could be appropriate to align your business and stock to be QSBS eligible. Because over the long term, you know, capital gains tax rates, you know, around 20%, you know, for a large transaction, that can save you a ton of money and dramatically increase your after-tax proceeds.
It is, I would just dovetail on that, pay attention to it early piece though, because we also have seen several times when people believed that they were going to be eligible for that, but they have blown their election 3 or 4 years ago. So you did a great job of highlighting the high-level criteria, but it is one where you need to be paying attention to details over the entire course of that 5-year holding period, because there are some technical compliance pieces that are easy to blow.
And many business owners going through a transaction wish they could turn back the clock 5 years earlier.
Can't flip the switch.
And start that, and you just can't. But spot on. Thank you, Billy.
And you can also take advantage of it when you sell to an ESOP.
You can, okay, good to know. So, you know, I've also had business owners who, well, one in particular stands out, who goes through the entire transaction process. They're on the eve of closing. Everything has been lined up. And then they talk to their wealth advisor and find out what they're getting net out of that sale is not going to fund the retirement that they want. So can you, Max, reflect on, you know, the importance of that aspect of the discussion?
Yeah, I think really what that is you know, quantifying within a high level of confidence what you truly need to accomplish your personal objectives, particularly if retirement is the next step in your life. You know, going back to the example of donating business shares to a donor advised fund, the very last thing we want to see business owner clients do is overgift, right? So, you know, this may benefit your heirs or other third parties that you care tremendously about, but that could also impair your ability to live the life you want and capitalize on the business you worked decades to build potentially, right? So it's first quantifying what that after-tax liquidity number needs to be to achieve your longer-term objectives, and then anything in excess of that, you know, that you're expecting from a future sale, you know, that could be legacy planning for the next generation. That could be charitable inclinations. You know, there's a lot of different ways you can go, but you know, I think it's super important to first understand what you need, and then with the excess, you get maybe a little bit more creative for other causes you care about and people you care about.
And Brian, let's dovetail on that. When, from the legal perspective, when should the exit planning start, and what should be done with the business to prepare for that process?
I mean, I'm going to echo the sentiment of today, but
As soon as possible. Okay.
And that's
Fair
not, and it's not a deep dive early on necessarily, but it's the same, you know, it ties with the same sort of things we're saying of you want to have your team in place and you want to have your legal team as well understand your business to a certain degree. But frankly, it's also about wanting to understand what sort of purchasers you're targeting, because you want to model your business in a way that is going to make you attractive to them. So that's the financial side. That's also what you're doing on an ops level, which we wouldn't necessarily be as involved in either, but then keeping your legal documents clean, you know, thinking about other forms of incentive equity or phantom stock plans or profit shares, things like that, and structuring that in a way that's not going to be a hindrance to a future sale. You know, I say early on because I frankly have a situation right now where the client is selling their business and wants to close next Wednesday, and he still has 6 or 7 assets that are his personal toys that are financed that we have to figure out how to spin out. Had he brought us on and brought more of the team together something like a year ago, that would be a lot cleaner, and it wouldn't be in a position where I'm going to opposing counsel, the buyer's counsel saying, will you let us get this cleaned up post-closing?
Right.
And that sort of friction with buyers and buyers counsel and stuff just puts you in a deficit in some of those negotiations and makes it more challenging to get some of the bigger wins that you're fighting for throughout the process. So I say as early as possible, because the cleaner your business looks from a financial, legal, and ops perspective, the faster and smoother the sale goes, and the more likely you are to accomplish your goals in that sale process.
And Doug?
Yeah, and just one thing to not lose importance is your succession management. I mean, if you're selling the business, the buyer's gonna wanna know who's gonna be in charge, who's gonna be able to make the hard decisions, who's gonna be able to move this company forward. So, planning for that succession and making sure that you're not integral to the business is key too.
Well, yeah, and that dovetails on making it attractive to those potential buyers. Who are your potential buyers? What are they looking for? So, Brian, I'm sure, the independence and lack of dependence on the owner. So the company has to be able to function without the owner. Not having just one or two clients, but having more clients. Are there, or customers? Are there other aspects of the business that come to mind that people should be looking at?
I mean, again, I would come back to just wanting to have a vision of what your ideal buyer is, because if you're in a situation where you're looking at PE money or some of the private money, probably part of the value proposition that they're giving to you is that they can operate much more efficiently than you could with the resources they have at hand. And so we have plenty of situations where that's what's going on, and the owner intends to continue working with them for 5-10 years and work off into retirement then and be taking some rollover equity in the company that's purchasing them. If your goal is to be exiting and riding off into the sunset and finding your way to a beach somewhere, then you need to make sure that you're not that the business isn't dependent on you. Try to think of other good examples, but I guess at the end of the day, it's really about, similarly, if you were selling to an ESOP or if you're looking to pass it on to key employees, then part of your process is trading them up, because typically someone who's interested in going that route is much more concerned about the legacy of the business and is more willing to do some seller financing and take their financial compensation over time. So there's just having a vision of what factors matter to you on exit and then designing around those.
What about anchoring to a specific valuation and number? Like, business owners may think it's worth $50 million, for instance, but as far as what they're looking to do in retirement, they don't need a $50 million sale to accomplish all that. Certainly, you don't want to leave value on the table, but how would you approach instances like that?
We always want to have a valuation. I guess my perspective is you don't want to leave anything like that on the table. And then we would turn to someone like you to help them deal with the tax consequences if it's much larger than they would anticipate. But again, an evaluation is not something you necessarily need to be regularly doing, but I would absolutely encourage third-party advice on what evaluation is, because the business owner themselves is certainly going to be skewed, but anchoring to a number is, I guess I would say that it's volatile enough in the market, especially with multiples changing quite frequently and stuff, that I would not want to anchor to a number. I would certainly have a number in mind of what I need to walk away with as the seller to feel comfortable, and everything beyond that is upside. Right?
And for those, has anybody here sold a business before? Okay, for those who have not sold a business, which is almost the entire room, can you describe, just in a nutshell, what that process looks like and what they can expect from that?
In terms of the business sale itself?
Just a standard business transaction. So if you're going from listing it, bringing in a broker or investment banker, listing it, through the closing and post-closing.
Sure. So typically, you're going to you'll be working with some sort of M&A consultant, whether that's an investment banker, a broker, or other sort of M&A consultant, and they're gonna help you, you know, all of them operate a little differently, but they're gonna help you build your books and financials in a way that's presentable to potential purchasers or potential acquirers. They'll then kind of market you out to those acquirers and try and collect IOIs or LOIs, so indications of intent or letters of intent, preferably letters of intent. Which is really just an agreement to agree. And if you sign off on a letter of intent, you're typically locked into some level of exclusivity period where you can no longer shop to other purchasers. And then in exchange for that, the potential target is agreeing to certain confidentiality provisions, and that just creates space to start the diligence process. Typically, you know, if we're not already working with you before that, that's when the LOI phase at a minimum is when you want to think about bringing your attorney in, because even though it's a non-binding agreement, it is framing the entire rest of the negotiation. So, you know, you could be facing a stock purchase where an asset purchase really makes a lot more sense for you, given potential liabilities and doing tax considerations or other tools to minimize taxes. Certainly would want your team to be involved at that phase. And then as the due diligence process is going on, that's where the business folks will have kind of a shared data room and are sharing all of their information with one another. And in parallel, the attorneys will be going back and forth with purchase documents. That process can be pretty quick and pretty efficient, or it can be very slow and painstaking. It depends on the sell side. It's going to depend on a lot on how clear your goals are and how all of the things we've just covered about what you want to get out of this and what your walkaway points are, negotiations wise. On a buy side, it's really they need to get far enough in to get comfortable both with the business as a going concern and their ability to take over and operate it in a revenue generating way, and with the liabilities that might be coming over with it from past operations. So I've seen that go as fast as 2 weeks, and I've seen it take as long as a year. It really depends from that stage. And yeah, I guess that's the general process. And then in the meantime, you're probably also negotiating a variety of ancillary agreements. So if there's any sort of seller financing, what the terms of that financing look like, if key employees are going to be offered employment going forward, what are their terms of employment? If you as the founder are being offered employment going forward, is there a severance package involved? What sort of protections are you going to have so that if you don't get along with new management, they can't just terminate you and cut off some of the value there? That's it.
And then,
Most of the full cycle.
and then everything always lines up and you close. Always. And then afterwards, the cultures just blend so harmoniously. So there is still some work to be done, and you try to minimize those pain points by working with professionals like these. So the point being, you know, don't lose sight of the importance of reverse engineering. And what I mean is set the destination, figure out the course to get there, and make your decisions now that align with what your objective is for the company. And I think that's a common theme here today. That and, you know, be courageous, be confident, be compassionate to the people around you, and find joy in everything that you do. With that, let me open it up for any questions. Unless we're out of time. I don't know what kind of time.
We're about the time of this session here, but I mean, I think we can field a question or two if anyone wants to volunteer something. Or
So we talked a lot about getting acquired. What about acquiring? Can you use ESOP to acquire?
That's a great
That's a great question.
Yeah, actually, if an ESOP is acquiring a company, it's possible for the seller of the target to also make that 1042 election to defer their capital gains taxes. And so, you know, you may be able to offer a lower price because the tax consequences are more advantageous to that seller. So, yeah, it happens quite often. What we're seeing now a lot of is that companies who become ESOPs and they've grown are becoming holding companies and are going out and buying companies to join their ESOPs. And, you know, an ESOP's an expensive transaction. You know, you have to have some scale to make it work. But this is a way for a smaller company to do that for their employees and not have, you know, all the headaches and expenses of actually becoming these.
And outside of the ESOP context, obviously, an acquisition is another option of growth. You can grow organically, you can grow through capital, you can grow through acquisition. That's a whole nother hour-plus discussion, so if you want to have that discussion, you can certainly call the people who would be glad to help.
Great.
But great point, thank you. Anyone else?
One more in the back.
Yeah, on the ESOP, how do you determine what employee owns what out of the transaction? Is that an internal, like, board decision, or does it have to be pro rata, or?
Oh, no, great question. So, so the ESOP is, you can't discriminate against employees, and it's a broad base benefit. So, you know, the way an employee is allocated shares each year, the most common way is a percentage of that, the percentage of that employee's payroll to the total payroll is the amount of stock that's allocated to that employee that year. So there's a mechanism that determines how much stock is allocated each year, which I can go into. But basically, it's a percentage of your payroll determines your percentage of your total payroll determines
So
that.
you could just, family try to transfer it to their second generation, give the second generation like 30% for the ESOP, but, okay.
Nope.
There's like,
Yep, exactly. Yep.
paying a lot more money, it sounds like.
That's right.
Anyone else? Just my friends in the back. I didn't even know you guys were out there. Thank you.
Thank you.
Yeah.
Sorry, I'm stepping on your toes. I'll
No,
turn it
no,
over to Rich.
But just want to say thank you to everyone for participating in this. I know there was a lot on the exit planning as well too. The acquisition side is also another way to scale up, and we could probably do a whole nother session on that as well too. But I think we're going to have one more panel after this. This is actually going to be an AI demonstration, and it's going to be some pretty valuable information coming up here in just a couple of minutes. We'll have the food and the drink starting at 4 o'clock as well too, and then we have the celebration starting at 5 o'clock. So again, thank you for attending this. Certainly appreciate it. We're going to get started. Yep, we're going to get started here in just 1 second.
Can we thank our panelists for that?